Aloha, Inspired Moneymaker. Thanks for tuning in. If this is your first time with us, welcome. If you're returning, welcome back to Inspired Money, where we talk about making smarter money moves so we can pursue richer lives. I'm your host, Andy Wong, aka Advisor Andy. We're digging into a topic that every investor is talking about today, but few feel totally prepared for, and that's market volatility. If you've been watching the headlines, checking your portfolio a little too often, or wondering whether we're in calm waters or heading into another storm, you're in the right place. Markets have been sending mixed signals lately, some flashing caution, others hinting at opportunity. And during uncertain times like these, the difference between reacting emotionally and making informed decisions can have a huge impact on long-term results. Our goal in this episode is to cut through the noise, look at what really matters, and help you build confidence no matter what the market throws your way. We've brought together an incredible group of investors and thinkers, people who spend their days studying price action, sector trends, business fundamentals, and the psychology behind market behavior. They know what volatility means beneath the surface, how to stay protected when things get choppy, and where the opportunities often emerge when fear is highest. So whether you're a seasoned investor or someone simply trying to navigate today's uncertainty with a bit more clarity, stay tuned. This is going to be a really insightful conversation. Before we jump in, I want to take a moment to thank our sponsor. Today's episode is sponsored by Seeking Alpha, the all-in-one platform serious investors rely on for market insights, stock analysis, and actionable data. Whether you're tracking earnings quality, sector trends, or volatility signals, Seeking Alpha gives you tools you won't find anywhere else, from quant ratings and factor grades to real-time crowd insights. Right now, through December 10th, you can get 20% off Seeking Alpha Premium. That's $239 a year, plus a 7-day free trial for new subscribers. This is all part of their Black Friday, Cyber Monday special. Continues until December 10th. Visit inspiredmoney.fm/alpha, that's ALPHA, to start your trial today. Seeking Alpha, get smarter, faster. Full disclosure, this is an affiliate link, which means I may earn a small commission if you sign up at no extra cost to you. Check it out and see why millions of investors rely on Seeking Alpha. Now let's bring in our guest panel. Our first guest is someone you've probably seen on CNBC, Bloomberg, or quoted in just about every major financial publication. Katie Stockton is the founder and managing partner of Fairlead Strategies and one of the most respected technical analysts on Wall Street. She's known for her disciplined, signal-driven approach to understanding markets, and she also manages the Fairlead Tactical Sector ETF, ticker symbol TAC, T-A-C-K. With over 2 decades of experience advising institutional investors, Katie brings a clear, steady voice to navigating volatility. Katie, welcome to Inspired Money.
Thank you, Andy. Good to be with you.
Next up is portfolio manager who brings both exceptional performance and purpose to his work. Mike Taylor leads the Simplify Healthcare ETF, ticker symbol PINK, which is the first 100% pro bono ETF with all net profits donated to the Susan G. Komen Foundation. Mike has spent more than 20 years running long-short healthcare portfolios at some of the most sophisticated hedge funds in the world, including Citadel, Millennium, and Diamondback. He's widely regarded for building one of the top-performing healthcare funds on Wall Street and for his deep understanding of risk, hedging, and market structure. Mike, great to have you back.
Thank you so very much for having me.
Our next guest is Seth Cogswell, managing partner and founder of Running Oak Capital, where he co-manages the efficient growth strategy, a disciplined, quality-focused approach centered on mid-cap companies. And it's available both as separately managed accounts and an ETF. Seth brings more than 2 decades of experience in portfolio management and multi-strategy trading. He earned his MBA from Wharton School and will share his data-driven perspective on navigating market uncertainty. Seth, great to see you.
Thanks for having me, Andy.
And rounding out our panel today is Gary Brode, no stranger to the podcast. He's managing partner at Deep Knowledge Investing. Gary brings more than 30 years of experience across the securities industry from his early days at Morgan Stanley to senior roles at Seneca Capital, Brahmin Capital, and John Levin and Company. He also founded investment firms including Akita Capital Management and Silver Arrow. Gary is known for delivering independent insight and actionable research for sophisticated investors, and we're thrilled to have him back on the show.
Thanks, Andy. Great to be here.
And you're homeless right now.
Yes, exactly. I rented my house out, and I have a year to work from everywhere and travel. It's been an amazing adventure so far.
It's got to be really good for perspective, giving you fresh perspectives. Well, we've got a great episode today. Thank you for tuning in wherever you're tuning in from. Drop a comment, whether you are on LinkedIn, YouTube, Twitter, Facebook, Instagram. We have the portrait format now. So we've got a lot to cover. Let's get started with segment one.
Volatility can feel like chaos, but investors treat it as data. The most watched signal is the VIX, often called the fear index. Readings below 20 suggest stability. 20 to 30 signals rising uncertainty. Above 30 reflects fear, and above 40 marks panic often seen at market bottoms. A contrarian investor may view extreme VIX spikes as opportunity, not danger. Supporting indicators add context. The put-call ratio shows investor positioning. High ratios reveal heavy bearish bets, which can suggest oversold conditions, while low ratios point to complacency. Market breadth tells whether rallies are broad or driven by just a few stocks, a sign of fragility. Together, these measures form the market's fever chart. By interpreting them correctly, investors shift from reacting emotionally to diagnosing conditions with discipline, turning volatility from a threat into a tool for informed decision-making.
Katie, how do you integrate VIX levels into your technical roadmap? And what role does it play in your sector rotation strategy within TAC?
Yeah, of course. That's a great video, by the way. I enjoyed that. It does show the cycle between fear and greed effectively. And the VIX I see as a transactional gauge of market sentiment. The way I look at it is that there's cycles. There's cycles in market sentiment. You have sort of lower volatility regimes and higher volatility regimes. And arguably, we've moved into a higher volatility regime as of really October. That's when we first saw the major equity indices in the US pull back from their highs in a meaningful way. And with that, we saw volatility pick up, meaning hedging became more prevalent, but not to the extent that it becomes a contrarian takeaway. We don't have a VIX reading above 40 in recent history. And that is indeed, that when you'd start to look for contrarian entry points. So we don't have that yet. And it just suggests that the market hasn't gotten, I guess, bearish enough in a way to lend itself to that contrarian type of low. And with these higher volatility regimes, lower beta strategies can be additive to portfolios for sure. I think what you tend to see, of course, is the high beta names tend to underperform on the downside or exhibit downside leadership, whereas the low beta names tend to do a bit better. Some can rally in the face of a market pullback, and others can just kind of hold course and stay above support levels on their charts. So you're better served, generally speaking, being in these lower beta areas of the market when the market is more volatile or correcting. Our ETF, the Fairlead Tactical Sector ETF, is indeed lower beta and also lower correlation to the S&P 500. I think we're all accustomed to these passive ETFs these days with high correlations to the S&P and heavy mega cap exposure, but that's not at all what TAC is. TACK. It's a sector rotation fund that uses equal weight sector positioning to leverage long-term sector trends, very long-term conservative positioning. And when the market's not working, we will happily move from those sectors into a combination of our other assets. So we'll move into short-term treasuries, long-term treasuries, and gold as the market warrants.
Interesting approach. Mike T, give us some context. How important is VIX or put-call ratio spiking within your multi-factor approach?
It is much less important than it used to be. Right now, we have a gigantic investor complex that is a simply short vol. There are so many instruments out there that are selling options on top of an equity strategy, puts and calls. And so it's had a material smothering effect on VIX and what it used to be sort of a barometer of risk and panic. And it doesn't express that anymore, I think, because of so many of the automated products that are on top of it. I can't think of a major institution that doesn't have a giant product around this. So there is always entities out there that is selling vol. And when it gets really juicy, it's automated where they come running in and they want to sell all that vol that they can. So it does set up for a potentially a very shocking market when that trade doesn't work. But we've seen in the past decade instant government intervention the minute that there is a cloud in the sky. Now, there's many reasons why they're doing that and why they're overreacting, I would say, to all of these instances. And we can go into those details in a little bit because that's a longer discussion. But I really don't take the VIX terribly seriously.
Seth, as a fundamentals-driven PM, how do you incorporate volatility indicators into your process?
We look at volatility in a somewhat unconventional manner, especially kind of the way that most look at it now. For me, the real risk that matters to investors isn't necessarily volatility or standard deviation. It's more downside risk and the risk of loss. And so that's really the biggest focus of ours. The biggest driver is a focus on valuations, which has not been especially fun over the last 17 years, especially if you consider the fact that the forward P of the top 10 holdings right now on a cap weighted basis is roughly 55% higher than the same at the peak of the tech bubble. So it's valuations have maybe never mattered less, but in the long run, they matter, right? Owning an asset that should go down or owning an asset where you have a ton of alternatives that can compensate you better just doesn't make sense in the long run. And then we also look at downside volatility in a number of different ways, but again, they're a little unconventional. Our goal is to provide the best exponential growth over the long run that we can for clients. And one of the ways that we look to provide that is doing whatever we can to avoid major drawdowns, because nothing destroys exponential growth like big drawdowns. So again, the VIX isn't necessarily a component of ours. We do look at betas. There's still shockingly a lot of people out there that believe that you need to take more risks to get higher return, invest in higher beta companies that outperform. That's been proven that's not even remotely true. Now, that said, over the last 6 months, which I would say was maybe one of the dumbest periods in the history of the stock market, you had high volatility, which is a basket of quite a few companies, was actually up 100%, which is the best run, at least as far as the data goes back. So volatility recently, to a large extent, has been rewarded, but over the long run, we know that it's not a good bet. So it's an interesting time, but again, we do it unconventionally. I really enjoyed listening to how Katie looks at it, but again, really protecting clients to the downside is our number one focus.
Gary, how do you weigh volatility signals like VIX against fundamental valuation metrics? What are your thoughts?
So for the most part, I don't. And I actually like what Seth had to say about this. The VIX is really more than anything a measure of feelings. And Andy, I can tell you the first time I was in a finance class in college and the professor said that volatility is the proper measure of risk, that made no sense to me at all. Real risk, as Seth said, is permanent loss of capital. But this is a theory that was created by the guys who started and blew up long-term capital management. That should have killed the idea. It didn't. And basically, I see how it can be hard for a lot of investors, but and most professional investors are practiced at staying unemotional when they're trading, when they're investing. We see our portfolios moving all day. We're used to being in front of a screen, and you just learn to stay calm. But if you're an amateur investor, you don't need to look at your portfolio every hour. And however you feel about it, you don't need to act on it. So I really just think, is my thesis intact? How much am I risking? And I don't really worry about it. The only time I look at the VIX, the only time I look at vol is when I want to price options.
Thank you for that. Mike T, I want to circle back to you on this idea that, the Fed has overreacted in its intervention and all the different vol strategies that exist today. Have you found like different things that you look at that give you that have become reliable in warning you that risk is rising?
I just had one of the most remarkable conversations last night at 12:30 in the evening with my daughter Phoebe. She's 16 years old, and she wanted to understand what bothers me so much about the finances and the debt situation. And I'll walk you through it in short terms. And it was one of those magical conversations where she sat there for an hour with me with the marker at the whiteboard, because yes, we have a whiteboard in our kitchen for 12 a.m. tutorials. And I got to explain to her the problem. The problem is the demographics. I promise you with great certainty, 30 years from now, the populations of most industrialized nations will be 30% smaller. And if you, so the unit consumption or the requirements for industrialized worlds is going to be down by a third approximately, based upon age change and, the aging of the population and the dead population and not having new babies. And that creates a situation where you have negative aggregate demand in unit growth. And our fractional banking system is not modeled for that. And meaning that every dollar is borrowed into existence. Therefore, it doesn't work if you have negative growth. You can't pay that loan back. And what we've witnessed, I didn't know when it was going to start, but it's already started and we're well underway of the government's overspending in order to fill that gap. And you can see it as evidence in China and Japan and Southeast Asia for most of it, and Europe and the US, where the governments are meaningfully overspending in order to have positive GDP growth, because we would probably not have positive GDP growth otherwise, and that would cause a calamity. And so you have an instance in Japan where they have inflation, they have negative population growth, and they are printing money and buying assets, and they can't, while raising interest rates. And so it is a conundrum wrapped in a riddle. You can't do that, and they're lying to the public, but they're doing it anyway because the alternative is a debt bomb collapsing. And that's why the central banks are overreacting to every cloud in the horizon, because if they can't keep overspending, we are going to have a massive calamity happen. And on that calamity, I believe that they will start printing money. And when I look at the actual organic demand out there for consumption moving forward over the next 30 years, it's negative. And that means that they can't stop printing once they start. And we already see it on the yield curves. And I got all the way with her down into the yield curves, and why, as the yield curves mature and we have to refi all this debt, by the end of the decade, it's a high probability that the US is going to be spending around 50% of our tax revenue to pay interest on debt. So they're going to have to start printing money. Anyway, that is what I'm talking about. That is what bothers me. Look, we can trade this stuff and make a fortune, okay? And we'll be all right. But for the bottom 50% of the world that is not in the investor class, it is going to be functional Armageddon.
Well, welcome to this feel-good episode of Inspired Money. If you're not subscribed, make sure that you subscribe to us on YouTube. Let's move on to segment 2.
In a true market storm, diversification alone may not protect you. That's where the defensive playbook comes in. U.S. Treasury bonds are the classic safe harbor. When panic sets in, global capital flows into Treasuries, driving prices up as equities fall. Gold provides a different layer of protection. It is not tied to any government or currency, making it a hedge against inflation and systemic risk. Within equities, defensive sectors like consumer staples and utilities offer stability, as demand for their products remains steady, regardless of the economy. Finally, protective puts allow investors to set a floor under potential losses by using options as insurance. Combined, these assets form a fortress. They don't eliminate volatility, but they ensure that fear itself fuels part of your portfolio, offsetting losses and preserving capital when markets turn unstable.
Mike, tell us how you've changed your portfolio this year. What does repositioning in the face of changing market conditions look like?
Thanks, Andy. I'll tell you the truth. I've pretty much never owned gold in my 25 years. And it is one of my largest positions, and sometimes my largest position, because of what I just stated. And gold is going to be a hedge for inflation and deflation. It's going to end up working both ways, because I think we're going to have incredible deflation, but at the same time, we can't have negative growth. And so we're going to end up having governments and central banks acting in accelerating earnest in order to create more M2 at any cost. And for your listeners that don't know, M2 is simply, let's just say, how much money there is out there. M2 must always grow. The money supply must grow in order for GDPs to have positive growth.
Gary, what's your perspective on using gold or treasuries as defensive anchors, especially when this market is dominated by what the Fed might do next?
Well, so Andy, I love one, hate the other. I have a very large position in gold because I bought a medium-sized position in gold and then didn't sell it. Bitcoin and silver are large positions for me. Bitcoin is by far my largest position. And the reason I like those positions, but don't like owning treasuries, is because of what Mike was talking about. Congress is going to spend and spend and spend. They are going to debase the dollar into oblivion, just like every fiat currency before it. This has been, we've seen this play out for thousands of years. And what we're doing follows the model that everyone else has followed, where they've debased their fiat currencies. And so I don't want to own bonds. I don't want to own dollars. I don't want to own any fiat. I want to own hard things that are difficult to replicate, as opposed to, our Congress, which is spending, on balance sheet $3-4 trillion a year, more than it takes in. But if you include the off balance sheet accruals, and I do include those, you're looking at another $6 to $8 trillion. So there's no way, as Mike pointed out, that the math works. You want to own the things that can't be replicated easily.
Katie, what do you see in gold, silver, other commodities? And I'm curious, are there patterns that you use to time a rotation into defensive sectors?
Yeah, of course. I mean, gold and silver and really all commodities lend themselves very, very well to technical analysis and momentum gauges, support and resistance levels, things of that nature. And I think nobody would argue against the fact that both gold and silver are in long-term uptrends, and they've even been exhibiting positive short-term momentum. In fact, silver has a pretty decisive breakout, and gold looks like it's headed that direction from consolidation phases. So we're encouraged by the short-term and the long-term action by both commodities. We do think that with these breakouts, they act as positive catalysts, especially when new highs are being logged and there's no resistance to hold the charts back. So we're very encouraged by the action. Gold, we think, is a great sort of lower correlation diversifying asset class. And that's why we use it in our ETF. We use it via the GLDM ETF. So it's a fund of funds. And the defensive sector rotation is quite different, of course, than a gold position, even though both can be acting as ways to manage downside risk. defensive sectors like healthcare, which of course has picked up relative performance recently, and consumer staples, things that tend to be necessities as opposed to discretionary things. And also almost anything that isn't technology these days seems to be somewhat defensive. But we let the long-term momentum gauges and relative strength inputs guide us to that end. And by relative performance, I'm simply looking at ratios. So looking at ratios of each of these sector proxies to the broader market measured by the S&P 500. And when you start to see the turnarounds unfold, there can be information as to the primary direction or trend, and also what kind of risk appetite there is out there right now. And as it stands, we hold actually sort of a balance between offense and defense on the sector front as we see this transition. And we have about a 25% position in those alternative asset classes, including gold.
Seth, your approach, you're very focused on high quality, which I suspect naturally builds in some downside protection. Are there things that you need to do additionally to build defense within your portfolio?
Our portfolio is rules based, so it's really driven by that kind of process and discipline. With the strategy has a 5-decade history. I didn't create it. My father actually created it. So it's really just me being a steward of the process, of the strategy. Now, so there's not really any conscious or discretionary decisions that take place. It's more really trusting common sense. I mean, because really that's the best way to describe our strategy is trying to maximize earnings growth or value creation, because there's no argument that isn't going to be a good thing. But beyond that, again, it's doing whatever we can to avoid overvalued companies or companies that should go down. That's not a good exercise. One of the areas of focus is also debt. It's a simple concept, but I believe it'll be pretty significant or important over the next decade. Over the last decade, companies took on more debt than any time in history. And in the past, they did so to invest in their companies to create more valuable companies. One of my favorite stories about buybacks is Mark Jacobs, who was the founder of XPO, and a short report came out on the stock and knocked it down significantly. And he went around to a bunch of banks, was able to round up a good amount of debt and bought the stock because they felt it was depressed and it was a good investment. And then it appreciated and they made a ton of money for their shareholders. That's not what happened over the last decade. Over the last decade, because rates were low, companies sold a ton of debt and they largely just bought back stock. And if you think of that in kind of its simplest form, taking on debt's basically mortgaging your future to receive cash today, and then they handed that cash to people that felt that their company was not a good buy. So it's a pretty funny concept, and the fact is they did so at very low interest rates. Rates are quite a bit higher. Companies are going to have to refinance. That's just simply the way that debt works. It has a time frame. Now, yes, the biggest companies, they've got really attractive terms, but regardless, you're going to have a lot of companies that are going to have to refinance at higher rates, which will hurt profitability. Profitability, even though I think it's a really dumb argument, is an argument that many use to justify higher valuations. So if you get a decline in profitability, therefore declining earnings, declining valuations, it's hard to argue that isn't a very real risk. And that's one of the things that we guard against. So again, it's not really a conscious decision, but it's just always a kind of an ever-present consideration for us. And again, valuations, no matter how you measure them, are pretty nuts. And that's also a way in which we really look to protect our clients over the long run.
Very interesting to see the different ways that one can handle dealing with volatility and managing risk. There's not just one way to do this. Let's move on to segment 3.
In turbulent markets, investors face a flood of noise, wild price swings, dramatic headlines, and short-term panic. The way through is focusing on signal, and the strongest signal is quality. Companies with durable profitability, strong balance sheets, and consistent free cash flow historically decline less and recover faster. Free cash flow is the ultimate measure of resilience. It funds operations, debt reduction, and growth without reliance on external capital. In downturns, cash-burning story stocks falter, while firms with high returns on equity and low debt remain steady. Historical data confirms this. Quality-focused indices consistently outperform the broader market during crises, cushioning losses. By prioritizing cash flow and balance sheet strength, investors avoid speculation and position themselves in businesses designed to withstand volatility. In uncertain times, quality isn't just defensive, it is the foundation for sustainable long-term returns.
Katie, can you measure quality or resilience purely from a technical or chartist point of view?
It's more of a factor that's fundamental in its basis. But we do analyze the factors usually in relative terms against the broader market to discover where there is opportunity. And we look also at things like small caps versus large caps, gold versus silver, international versus US. And these comparisons can help you understand where there is opportunity and where perhaps a portfolio should be overweight or underweight. We always assume sort of a US large cap equity core, and that indeed is what TAC serves as. And around that, we encourage investors to build positions in segments of the market that have that momentum, that have that relative performance trend behind it. And, right now that is large cap US equities for the most part this year, but at times it is not, right? And even this year, we have seen a shift towards international markets for one. So in the early parts of this year, we saw relative improvement in developed global and emerging markets versus US. We think that's the beginning of something, at least that's a more balanced environment between international and US equities. So we watch these shifts very closely, and we do have from our advisory client base, I would say a lot of interest in quality names and dividend paying names. So we are definitely seeing that as one of the trends.
What's your read on big tech and especially AI right now? Do you see momentum continuing in 2026, or do you see investors backing away from some of those positions?
Well, we don't have any long-term sell signals, so that's the good news. We certainly have a loss of intermediate-term momentum behind a lot of large cap technology stocks and also a lot of AI stocks that are not large caps. So I think that tells us that the correction that we've already seen probably is not going to release hold, in the very near term necessarily. But on the back of that, once we feel like the indicators line up for a better buying opportunity, I think we assume that the long-term uptrends that have been established there for a long time are going to resume. It's usually the right thing to do is to assume the prevailing trend will sort of remain in force until it proves us otherwise. The one sort of caveat to that, I would say that I'm seeing in the charts right now is that Bitcoin, which has been sort of a proxy for risk appetite, has a long-term momentum sell signal that's pretty new, and it does give one some pause. I think it's a little bit early and limited to these risk assets that are pretty far down that risk spectrum, and yet it is something that could certainly carry over to the AI trade or otherwise. So that's what we'll be watching, those long-term momentum gauges.
Gary, you track Bitcoin and crypto closely. What are your thoughts?
So Bitcoin is my favorite position, my largest position right now. When we were talking before about the issue of, volatility, I just don't care. I originally bought Bitcoin at 15,000. It ran up to 64,000 and then back down to 15. And I didn't get upset. I didn't panic. I didn't sell anything. We just bought more at 15. A week or two ago when it dropped down to the 80 to 84,000 range, just backed up and bought more. I think, a lot of times people will say to me, hey, I'd love to own Bitcoin, but I missed it. And my response is, do you think Congress is going to stop overspending? Well, no, of course they're not. They're going to debase the dollar into oblivion. We were talking about this earlier in the show. So I think, anytime you can own something that has a hard cap of 21 million, where more than 95% of that has already been issued, you're in a pretty good place for that. I want to own that long term, regardless of any kind of short or medium term volatility.
Seth, give us a little insight into your approach, filters that you used for identifying true quality, especially in the sea of overhyped narratives.
Again, our strategy. So I would argue that the best answer to life's most complicated questions is often the simplest. And another way to kind of, let's say, a synonym for simple in a good way is elegant. So again, our strategy has a 5-decade history, and it's really been boiled down over that period to some very simple, common sense metrics. So again, really seeking to maximize earnings growth, which implies quality, right? Because you can't have earnings growth if you don't have profitability. That focus on debt, which I mentioned. And so we don't necessarily invest in quality intentionally or explicitly as much as we just end up there. And the reason is, there's lots of terms out there in our industry. Quality is really just a common sense term for investing in a good company. It's really, we like to use these complicated terms. It's just investing in good companies. And so really that's what we seek to do, right? To invest in the best companies that we can, that are growing at a good rate, that have seen usually, so in the markets, because according to Warren Buffett, right, he made the quote that in the short term, the market is a voting game. In the long term, it's a weighing game. So in the long term, it's efficient. The numbers actually matter. Gravity matters. In the short term, it's a popularity contest. And so our process is really designed to take advantage of that popularity contest. As money is flowing into companies for whatever reason, say different reasons than ours, it's going to push those companies up. They become a larger part of the index, pushes the index up. And that means that a certain amount of money is not flowing into other companies. And so we're seeking out those companies that are not being pushed up, really investing in good companies, so quality. And then over time, because the market is a weighing game over the long run, usually over the course of 5 to 6 years, investors realize the error in their ways and we sell and then look to find something else that's a little less popular.
Mike T, there are times when you want to invest in quality. There are other times when you might want to invest in more speculative names. Where are we right now?
Oh, great question. So we're at there's two pieces to it. Number one is a economic cycle, and where we're coming out of a slow growth phase into very, very easy comps in the front half of next year. And most of that is going to be helped by the tax checks that folks are going to get. Bigger tax return, $1,000 to $2,000 per family, and they're going to go and spend it. And so, consumer, casual dining, things like that are going to do very well, and debt payments are going to look better in the front half of next year. So it's really just a little teaser that you're getting, and that's really how you trade it. But so far as like the second part is the macro overlay, and I agree with our friends out here that the government is going to keep spending, but we have a huge problem right now where they actually can't, and that's the real cloud that I see that they're running into, is that the bond markets are going to go AWOL, and already are. And so what they're doing in response to that is funding on the very short end. And we're seeing them game the system. Even here in the US, just saw what happened with the regional banks. Smaller banks can now lever up and buy treasuries. They're going to get that allowance, and that just went through a week or two ago. So they're going to be able to buy on the short end of the yield curve to keep funding the government, which is going to keep pushing duration down. And so it's kind of a short-term fix for a giant term problem that they more and more can't get out of. Countries cannot issue money on the 10-year plus yield curve. And they don't want to do it because then you would have price discovery. They do not want price discovery. So that's the overarching second theme. So short term, I think that it's going to be, believe it or not, consumer discretionary to buy right now and out of defensives and into that. But that's only a trade into the front half of next year. And beyond that, honestly, I could predict further in the past, but now I can't, because the entire world economy is simply dependent upon stimulus efforts from every central bank and government. And that's it. We have deviated from normal economic cycles. They do not exist anymore. It is simply how much the government is going to overspend determines the number.
Well said. Let's move on to segment 4.
Market crashes don't just test portfolios, they test emotions. In moments of fear, the rational brain often shuts down, replaced by instinctive fight or flight. The best defense is preparation, not reaction. A panic-proof playbook is a written plan that tells your future self exactly what to do under pressure. It begins with an investment policy statement that defines your goals, allocation, and rebalancing rules. Then you layer in if-then commands. If markets fall 10%, rebalance back to your target mix. If they drop 20%, deploy half your cash reserves. At 30%, deploy the rest. For individual stocks, review your thesis before acting. These rules transform chaos into clear steps. Instead of panicking, you execute. By pre-committing to systematic responses, you shift from emotional reactor to disciplined investor, ensuring volatility becomes an opportunity rather than a threat.
Gary, do you believe in hard rebalancing rules or more flexible judgment when chaos strikes?
I don't focus a lot on rebalancing rules. I think a lot about two things: individual positions, and also, we're talking about big picture risks. I always just want to be prepared for what's coming next. And we hear the same thing on this show. A lot of us are focused on the same issue, which is governmental overspending. And everyone right now is focused on the $38 trillion in on-balance sheet debt. And with that, interest expense is over $1 trillion a year. But once you include the off-balance sheet liabilities, which are real, the real indebtedness of the United States is almost $250 billion. That's not going to be paid. So what we need to do is prepare for higher inflation. And my favorite ideas right now protect against that biggest risk. And we talked about it before: Bitcoin, gold, silver, energy. I spend most of my time focused on buying high quality companies with a lot of free cash flow. We were just talking about that. And I think it's also really important when you're looking at free cash flow to focus on whether capital expenditures are there to keep the company running or for growth. Just as an example, one of my big positions has been Las Vegas Sands. They're spending billions and billions of dollars expanding the Marina Bay Sands in Singapore, but the growth there has been incredible, and the place has been packed, and they're doing numbers that are beyond even what management had hoped for. So, if you're going to go build something that's going to be full and grow long-term cash flow, it's a good investment. And if I can find a few things like that a year and stick to my investment thesis, that's really where I want to be, instead of thinking about minute rebalancing.
Seth, your process is rules-based. For our investors at home, what's one rule that you rely on or they can learn from that would help them most when volatility spikes and emotions run high?
Well, I guess there's a bunch of rules, but we'll focus on a simple one. In the video, I love these videos, by the way, they're excellent. We maintain an equally weighted portfolio. Now, it's not equally weighted by the day, but the idea is that we are not deep fundamental managers. We have absolute conviction that if we maintain a portfolio that consistently has as high earnings growth as we can get with attractive valuations, lower downside risk, we believe that if we can do that consistently, it'll provide outperformance, lower risk over the long run. Because we're not deep fundamental managers and don't have deep kind of conviction or high conviction in any one name, we equally weight. Now, it's been an interesting time, I guess, in a whole lot of ways. I mean, just this discussion has been fun, but it wasn't that long ago where equally weighted portfolios had outperformed their cap weighted counterparts over every single rolling decade in history. The only exception is now the last, decade or so. And it just goes to show that discipline around noise, because again, going to the quote that I mentioned earlier, where over the short term, the market is a voting game or a popularity contest. Generally speaking, the market's pretty noisy. You got things going up and down for whatever reason. Usually it's not some sort of persistent fundamental reason. And so by equal weighting or rebalancing, you end up kind of taking advantage of that noise and taking advantage of that mean reversion. Now, again, one of the exceptions, the only exception in history, has been the recent decade or so where momentum last year hit the 99.8th percentile in history. And that's going to favor the opposite of rebalancing. It favors no discipline and just sitting there and riding the wave. I've never been a surfer. I'm always looking to, kind of be on the other side of things. So that rule fits my personality perfectly as far as rebalancing and kind of counterbalancing both risk, but also sort of putting mean reversion in your favor.
Mike T, how did you train yourself and your teams to stay rational during violent market moves? And how has that evolved with experience?
Pepto-Bismol. I only drink things that are pink.
On brand.
On brand. That's an incredible question. So, as you know, I've been in the hedge fund business for most of my life, my adult life. And one of our keys to outperforming was materially outperforming in down markets. And maybe you're just born with a gene. I don't know exactly what it is as to why some can see it and some don't, and some are willing to put the bet on and others aren't, even if they see it. Going materially net short is something that I've been able to do from time to time. And it's actually helped me. I haven't had a down year yet in my career. And every year I think, well, this will be the month, the quarter, the year, every time. And I suppose that's the approach to survival, is just assume you're going to lose. And I'll tell you how I did it to survive in that regard. I started every year with the assumption I'm getting fired this year. And I start with 0. And if you have 0, you're getting fired. So do something different than 0. And that's kind of how I always approached it, and how to survive and persevere, as I just assume I'm going to get killed, and I'll do everything I can to not. And then the end of the year comes, and you're good. And so, and I never look back, really. I mean, I do now because people always ask me about the performance of Pink and how we've done what we've done, and what I plan to do moving forward. And even in the moment, I wish I had really brilliant answers for you and how to navigate that. So did you have a follow-up question that I could be more intelligent on?
That's clawing for absolute performance all the time. And
yes,
that will get you to see another day.
It is. It really is absolute performance all the time in my approach. And then the sizing, I trained myself and been trained and experienced that sizing matters, and dramatic sizing matters. And so part of my French, if you have the nuts, you got to bet. So that's it. And when I see it and do the work, and I think that we have the nuts on something, we will be sizeola, because this only happens so many times a year. Like your example earlier on Las Vegas Sands, I agree. I'm following that very closely. I don't like China, where they're growing, but for some reason, they keep gambling.
Katie, what technical indicators do you pre-program into your strategy to avoid emotional trading in crashes?
I mean, all of the tools that we use are mathematically based on price. So they're by their nature unbiased. And thank goodness for that, because we're only human, right? And I also would say that philosophically, I agree with Seth on a lot of points. And you can both leverage the volatility and make it your friend and see it as opportunity. And at the same time, navigate the noise by using indicators that smooth things out. Like a very simple one would be a MACD indicator, the moving average convergence divergence indicator, one of the most common technical tools out there. And if you throw one of those on a monthly bar chart, you're inevitably eliminating a ton of noise. But if you'd rather, and you have the time to be a short-term trader, you'd maybe want to use that on a daily chart, right? So it's a matter of time frames and what you're trying to take advantage of in your sort of style of trading. In our ETF, we're very long-term. So we are using month-end closing data with a variety of technical indicators to try to understand where the best opportunities are longer term, and also trying to make sure that we don't get into trouble by riding those really big drawdowns and bear cycles to the point where we're having to dig out of a much deeper hole. So volatility can be your friend, and there are ways to navigate these big drawdowns by using simple price-based tools.
Well, kudos to our guests, not only for valuable insights, but thank you for retweeting the session. You guys have impact on X. I think we're up over 2,000 viewers at the moment. So if anybody's a first-time watcher, be sure to subscribe to Inspired Money on YouTube. Let's go to the next segment.
Bear markets feel endless, but history shows recoveries come faster than the decline. The dot-com bust took 30 months to bottom, yet the rebound was underway within weeks. The financial crisis dragged markets down for 17 months, but the climb back started immediately after the low. And in 2020, the S&P 500 lost a third of its value in a month, only to recover in 5. The lesson is clear. The steepest gains often occur in the earliest months of a new bull market, when panic is at its peak. Another pattern is sector rotation. Defensive names protect in downturns, but the strongest returns after the bottom come from cyclical sectors: consumer discretionary, industrials, and technology. Staying invested through fear and reallocating toward these leaders is how investors capture the recovery's full potential.
Katie, are there technical clues that show up around major market bottoms that most investors miss in real time?
So at the start of the show, we were talking about the VIX, and that is one of those inputs that we watch at market lows or to identify market lows. It's when things are at extremes and are very emotional on the part of investors that you tend to have that kind of buying opportunity. And when the S&P 500 bottoms, you can trust that most individual stocks will bottom to the day alongside the S&P. So it warrants top-down inputs as a priority. We should always have a bias on the S&P 500, even if we disagree with how concentrated it is. It is sort of the driving force behind market sentiment. So we're always looking for extremes, and those extremes can manifest themselves in sentiment data like the VIX, and also breadth data that's looking at the number of stocks up and down on up days, that type of thing. Leadership data that includes even sector rotation. Are the sectors getting extremely overdone one way or the other? So there's a multitude of inputs that we consult. And then ideally, you see it in price where you have maybe a reversal day and a very strong close after a big down day, something like that.
Seth, what patterns have you seen coming out of when there's a rebound? What type of companies are recovering strongest?
This might be one of my least popular views. I feel like I anger a number of people on this. I hate I'm going to slightly twist your question. I hate the 20% definition of a bear market because it's just a random round number. It's right. Like they took the number 10 and multiplied it by 2. There's literally no validity to 20%. The way that I see a bear market is as a philosophical or a psychological phenomenon where you go back to watching the video that you just showed where people were shaking their hands and like panicking. That's where you see the bottom of a bear market, is when people stop buying the dip, which, you know, buy the dip has been more successful the last few years than any time in history. So very clearly we aren't even remotely close to a bottom. Now we're at highs, so obviously that's the case. But regardless, you know, it really, you have to get to the point where when people think about buying the dip, they have an allergic reaction and they maybe even go into like fits and they run as far away from their computer as possible. That's when you know you've hit the bottom. I think especially today, when I will truly feel that we've hit a bottom is when at least a good number of the zombie companies, there's more zombie companies than any time in history at this point. You know, for those watching, those are companies that have so much debt that they, to service that debt, it's beyond their cash flow, right? They can't even pay for their debt. Until those are gone, I don't believe that we've bottomed. And when we do bottom, again, another contrarian view, one of the reasons why I think small cap and value has struggled so much is because, first of all, the conclusion that was reached as far as why small cap and value provide value, which is that you're taking on more risk, so the market gives you this risk premium. All of us have been in the market for a while. The market's never handed me anything for free. I don't know about you guys. Maybe the market's just reached out and with goodwill handed you whatever. My hypothesis is that those areas are distressed, generally speaking. And when you go through a bear market, you have a lot of those, the worst of those, die. And now you have survivorship bias at highly depressed valuations. And that's where you get the major turnaround and the significant bump up. So that's what I'll be watching, is for small cap and value to get smoked and then to perform extremely well.
Gary, what market behavior signaled to you that we've hit bottom, even when headlines still scream fear?
You know, Andy, nobody rings the bell. You don't see it in the headlines of the Wall Street Journal. You know, Seth was talking about everybody is trained to buy the dip, but nobody tells you if it's a buy the dip situation or if you're catching a falling knife. You know, you mentioned during the film that runs between segments, the bear markets that recovered really quickly. But, you know, people don't remember that the crash in 1929 and the 1970s crash, and the Nifty 50, those took a long time to fully rebound. In 2008, we got a really quick recovery, but that was due to Congress and the Fed becoming incredibly stimulative. But every time you do that, you need to stimulate even more. And there's a point where even that doesn't work. We're at the point now where a lower Fed funds rate just makes people assume higher future inflation. So I think it's really hard to tell with stuff like this. I mean, right now the Fed is cutting, but you're not seeing a decrease in the 10-year or the 30-year. So their ability to spend us out of the next one, who in the world knows? I'd just like to focus on the companies where I'm invested and make sure that my thesis is right. And that's really, if I stick to that, I'm going to do well.
Yeah, I've found that those market tops and market bottoms are highly emotional. And I have the benefit of working with clients, so I get anecdotal feedback. Back in 1999, I had a near 90-year-old client call saying that she wants to own Yahoo, and I knew that that was a problem. And then there are other times when, you know, it's not the majority of clients, but you just have a handful, and they want to sell everything. That's usually the bottom, and it's usually the same one. So they're very useful gauges. Mike, I want to go back to you. How is it that you can quickly rotate from a short to a long?
Oh God, yeah, that's one thing that we would do, is that when I'm selling my biggest long, when I was running a hedge fund, I would instantly consider if it should be my biggest short that day. And they did an analysis at Citadel on me, and that, how was it? When I covered a short, within 2 weeks, it materially outperformed the market and its peers for about 2 months. And they wanted to build a book just off of the shorts that I cover, where it would automatically, systematically go long after I cover it. And that was a real teaching moment to me, that when I am selling a long or covering a short, should I be seriously considering flipping the position on that? And that's so it's really introspection. And if you want to get better at this, be very, very critical of yourself in what you're doing. For instance, every month at Pink, we will look at all of the healthcare names and say, what is the absolute best return on the dispersion of stocks? And then I'll say, that's the winning hand for the month. Now, did we have that winning hand? And in that winning hand, could somebody skilled in the art of this practice in healthcare investing, could somebody have known it? Or was it just a bunch of lucky takeouts and a clinical trial blew up that you couldn't have seen coming? But could somebody skilled in the art actually had that immaculate winning hand? And just be critical, very critical about your choices and what you did, and look back over every month and every quarter and ask yourself, what was a winning hand? Could I have had that? And what am I doing wrong? Or what can I do better to have that hand? What am I missing? And the stock market really offers you that critique, sadly, in real time.
That's a real report card all the time, every day, minute by minute. Mike, clearly you have to have an investment thesis that's based on fundamentals. Then are you just looking for the technicals to agree with whatever bet you're going to take, whether it's long or short?
Wow, that's a great, incredible question. And yes, frequently when I have a fundamental view on something that's material, and I think it could be a very, very big idea, especially if it's an execution situation rather than a binary event. But on an execution situation, I will have the view, and I will frequently have the position on to a modest degree. And then once I see that the market is starting to figure out what we know, then supersize. And it saved me a lot of time and agony in learning how to wait. And it's called delayed gratification. You know, once you get the hot idea, you want to put it all on right away, but you really need to wait if you're a professional at this and do it full time for the signals to start showing you. And I hate saying that. I truly hate saying that. I really do, because I'm such a fundamental guy at heart, but I've really had to force myself to wait for the beginning of a break, wait for that sign, wait for that buying that just starts coming in. I'm like, they're starting to figure it out. Let's go. And we got to get big then. And that's so, and I'm sure all of us here are trying to practice that exact same thing. But I'd really reserve that for the professionals that do this full time and don't have a day job otherwise.
I think we will conclude there. Thank you to our amazing guests for their incredibly insightful conversations. So what was your favorite inspired money moment? One of my favorites was this: volatility is not necessarily the enemy. Reacting without a plan is. When you have a framework, like we heard from our guests, those big market swings can stop feeling like chaos and start looking more like opportunity. So here's your assignment for the week. Write down just one rule that you'll follow the next time the market pulls back. It could be an allocation target, a rebalancing trigger, or maybe it's just a Post-it note that says, I will not sell on fear. Put it on paper. Your future self will thank you the next time emotions start running high. If you found value in this episode, share it with a friend who's navigating uncertainty too. I would love to connect with you on LinkedIn. Find me by searching Advisor Andy. Inspired Money is created and produced by me and Bradley John Eaglefeather. Bradley is behind the scenes during the live stream. He edited the segments, so I'm sure that he appreciates all the positive feedback from our guests today. Chad Lawrence does our graphics, animations, and editing. And before we part ways, a big thank you to our insightful and amazing guests. Check out Katie Stockton at fairleadfunds.com and follow her market insights as founder and managing partner of Fairlead Strategies. The Fairlead Tactical Sector Fund trades under symbol Tack, T-A-C-K. Follow Mike T on X and visit him at simplify.us to learn more about the Simplify Healthcare ETF, the world's first 100% pro bono ETF supporting the Susan G. Komen Foundation. Look up ticker symbol PINK. Mike T, kudos to you because you've had a great year and a hell of a November. Holy smokes.
Well, you got to look at it in a relative basis, right, versus the benchmark. And I'm very pleased with our performance. I'm not allowed to talk about the performance, but I can say I'm pleased with the performance since inception, which was 4 years ago. And I encourage everyone to compare the Pink performance to all the other folks running healthcare and the benchmarks. And you may come to the conclusion you want to join me in Pink.
Check out Seth Cogswell at runningoaketfs.com to explore his disciplined, quality-focused, efficient growth strategy at Running Oak Capital. The ETF trades under the ticker RUN, R-U-N-N. And Seth, I understand that RUN is one of the is it one of the like most fast-growing ETFs, at least at launch?
That's what I'm told. I haven't actually seen data. We launched with 2 million in client assets, and it grew to 370 million or so in a little over 2 years. So for a tiny, well, maybe not tiny, but certainly a boutique firm that's not able to take other client assets and put it in there, I'm told that it's one of the best launches ever. Again, I haven't seen the data, but it makes me feel good at night. So I repeat it to myself on a regular basis to make me feel good.
Well, congrats with the ETF managers who are on this panel. I'm sure it's appreciated that that's an accomplishment, and it's a tough grind to continue to market and grow an ETF. And lastly, visit Gary Brode at deepknowledgeinvesting.com for independent, actionable stock ideas and market research from his 30 plus years in the securities industry. Do you guys have anything that you want to plug?
Oh, I'd like to mention, I'm not going to plug anything, but we didn't talk about what's going to happen next. And that's the most important thing. I think that next year is going to be extremely volatile in a stock picker's market. I think that there's a high probability that there is going to be a political attack on AI. And I won't say an attack, but more of a protest. And that may form in the spring and be one of the talking points for a political party that the advance of AI needs to be regulated because it's disrupting the job market too much. That may be a really big pivotal moment for that investing space. And keep your eyes open for it because everyone's going to have to move their feet very, very quickly.
And it sounds like the first half could look very different from the back half.
Yes, quite.
Anybody else?
If I may, to echo Mike's sentiment, and then a theme throughout this whole segment, which was risk. We all have recency bias, and it's been 17 years since we've truly experienced an extended bear market and actual risk of loss. And so I'm trying now, whether I'm effective or not, to really get people to envision what it'll feel like to actually watch your account balance go down, because we haven't seen that in so long, at least not for an extended period of time. One of the ways I'm arguing to really guard against that is diversification away from 10 companies. 10 companies, the 10 largest companies in the S&P now are, if you look at forward earnings, they have a 55% higher forward PE than the top 10 at the peak of the tech bubble. The concentration of those is 50% higher than the peak of the tech bubble. Per Michael Burry's recent post, there's a decent chance that those earnings aren't entirely accurate and maybe artificially high, which means that those valuations are, if you just make a small tweak, the forward P might actually be roughly 90% higher than the peak of the tech bubble. Who knows how this plays out? AI is it's a dynamic time, but most people do not need more of 10 companies. Really consider investing in other things, such as many on this panel discussed.
Gary, any final word? We're still waiting for your top hat and monocle.
I don't have them in my suitcase that I'm traveling with right now. Look, Andy, I think the other panels have brought up some really good, legitimate concerns going into 2026. I agree with them on that. My answer to that has been to be heavily invested and heavily hedged. I don't like having to wake up in the morning and wonder, is the Fed going to bail me out, or, even think that's a particularly good way to invest. So it's all right to hedge out your portfolio and live or die with the performance of, your positions versus the market. At a minimum, you can still be heavily invested and take some risk off the table. These two things don't have to be correlated.
Well, thank you for that. Thank you, everybody, for tuning in for this episode and this discussion. Inspired Money returns next week on Wednesday. That's December 10th at 2 p.m. Eastern. You don't want to miss it. The topic is Mindful Retirement, Creating Financial Peace and Personal Fulfillment, featuring guests Vicky Robin, Jordan Dakji Grummett, and more. I look forward to seeing you then. Until next time, do something that scares you, because that's where the magic happens. Thanks, everyone.